Hello and welcome to another episode of the Investing with IBD Podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern, as we typically do on Wednesdays. It's October 8th, 2025 today, and I am so pleased to welcome back to the show someone who I have learned personally from a lot. It's Tom Sosnoff. He is the founder of Thinkorswim, the founder of Tastytrade, and for me personally, I still use Thinkorswim. I was talking to Tom and I'm like, I've tried other platforms and it just takes so long to switch platforms. I'm stuck with it. I can't move because I just don't know how easy I would find to maneuver through other things. Tasty trade videos, that's how I learned options. It was basically watching those videos, watching Tom, watching you and your daughter, Tom. Was so enlightening. Liz and Jenny, the moms from the floor that kind of did their thing. It was so incredible how much education you come out with, and yeah, it's great to have you on the show again.
Thanks for having me. Love
Absolutely.
being back.
Yeah, and I should say, for those of you that maybe saw Tom's goodbye to Tasty Trade, he does have a new venture. We're going to talk a little bit about that. But before we do, let's talk a little bit about your Thinkorswim and Tasty Trade experience, because I think it's just, again, you had a lot of years on the floor, 20 years on the floor of the CBOE, and then you go and make not just one, but two very disruptive platforms in terms of how much you changed how retail audiences approach the market. So what kind of was your inspiration for this? First for Thinkorswim, and then to go out and do it again.
You know, it's hard to say that there was an inspiration other than I think if you were a floor trader like I, grew up on the trading floors in Chicago, um, you kind of stood in one spot for about 20 years. Imagine
Mhm.
I'm a big guy. Imagine 2 feet of space, maybe 1 foot of space,
Uh-huh.
for 20 some odd years with a bunch of, sweaty guys screaming and yelling in your ears and spitting on you and all that kind of stuff. And I mean, you get used to it and kind of love it. It's your life. But at some point, you're like, maybe there's more to this world. So my inspiration was, you know, my inspiration was I was I survived for 20 years. So
Mhm.
I was a good trader because if weren't, you didn't make it. And so I was one of the, small percentage that lasted 2 decades. And at that point, we had made a reasonable amount of money and we were in a position where we could do something different and you know, try to we didn't know where it was going to take us, but we were like the trading floors are going to become all electronic over the next whatever it
Right.
is, 5 years, 10 years, whatever. The writing was on the wall, and we always had this. If you remember the first, well, you probably don't remember the first Thinkorswim site, but we turned the S&P 100 pit into a swimming pool with ducks in it because that was what our vision was of the future, and that was our first website. This entire trading floor is just going to be a bunch of it's going to be a bowling alley and swimming pools,
Uh-huh.
and that was kind of the inspiration was just that, hey, it's time to do something different. There was no, hey, we're gonna turn the world upside down, we're gonna reinvent retail trading or any of that kind of stuff. We were just like, it's time for us to do something different. And Thinkorswim was a fun name. We had a fun idea and we rolled with it. We took all the money we had made in the prior 20 years and we bootstrapped it. We raised a little capital and we went for it.
Hmm. Yeah. I mean, again, a very incredible product. Of course, that got sold to TD Ameritrade, and then Schwab bought TD Ameritrade, and so now it's part of Schwab. But
Yeah,
again, I
it's
I
amazing.
still.
It's outlasted. I used to joke with the CEO of TD Ameritrade. I would tell him that Thinkorswim is going to be around longer than TD Ameritrade would be, and or I really thought that TD Ameritrade would become Thinkorswim, and he
Mhm.
would always say to me, "Over my dead body, will you stop? Shut the f up already. It's not going to happen." And then it happened, and
Yeah.
he had to buy me dinner afterwards and all that kind of stuff. Um, but Toss was an amazing company. It was a lot of sweat equity. We stayed up there was days we went 2 or 3 days without sleeping, just building it. It was an amazing experience, and
Hmm.
I learned so much, and I loved every minute of it. But when we sold it, it was time to do something different. And then it became Tasty, and Tasty became my new love. Like, it
Hmm.
was the most amazing platform, the most amazing content. And so, Tasty became just a whole different animal. And
Hmm.
that was the
So
next 15 years.
yeah, right. So yeah, exactly. You have like these back-to-back careers, like a
Yeah,
full
yeah,
career, 20 years, and then it's like, okay, now let me move on to the next thing. But with Thinkorswim, I didn't even realize this until you told me in the pre-show that when you originally came up with it, it didn't even have charts because you when you were on the floor, you like didn't realize that charts were a thing out there that people used. So
no floor trader ever had looked at a chart. I mean, we were all standing, butt up against each other. Really, there was a lot of people, 400 people in like a small area,
right. Hmm.
and you had no room to charts. You didn't even have news. You didn't look at anything. Every trade you made was just based on order flow, and
Hmm.
so there, there was no, when we built Thinkorswim, we thought, okay, we're going to revolutionize, or we thought at the time, we're going to change retail trading. We use the term revolutionize because we're going to introduce derivatives to the public.
Yeah.
And we did. At that time, derivatives made up about 8% of the marketplace. Today they make up almost 75% of the marketplace. And
Incredible.
so we did change the whole universe of retail trading, but we thought it would happen through options, through strategy, through capital efficiency, and we thought it would happen through cool technology. We didn't know people even looked at charts. Like, we
Hmm.
really didn't. We launched the platform without charts. And as I was telling you earlier, I reached out to a friend, Tim Knight, who was in Palo Alto, who built a charting platform called Profit Charts, and flew out, met him, and said, "Hey, Tim, we're a Java-based platform. You've got a Java-based charting platform. Um, Let me license it." And I licensed
Hmm.
it from him. We put it inside Thinkorswim, and we left it there for the next, 15 years. And then we built our own charting platform, on top of, I mean, next side by side with Profit Charts, and that became, a huge platform in there.
Hmm. So you mentioned how much the derivatives market has grown, and when we say derivatives, we're talking about options, futures. You've got the underlying stocks and indexes, and then
Yeah.
all of these things that you can do with them, basically. And as you said, this market has exploded. I mean, when you started, the volume in the options market was minimal, and I mean, if you look at a chart of how that volume has increased, it's just astronomical. How has that changed how you approach things? I mean, it's certainly offered a lot more liquidity. I mean, the spreads used to be, just huge between the different options, and I mean, if you bought it, you were immediately down like 10% or more. So, talk a little bit about how things have changed, and have you had to adjust your strategies because of that?
Well, I'd like to think we were on the kind of, on really on the front lines of all those changes. But when we first built Thinkorswim, they did about somewhere between 8 and 10 million options a day on average, you
Hmm.
know, through all the exchanges. Today, last week on Friday, I think we did 86 million. Just to give you an idea of the growth over the last 24, 25 years. Um, when we first started, we were pushing through about 25, something like 25 million quotes a second, and now we're up to, like, 250 million.
Hmm.
It's 10x of everything.
Right.
But the real reason for there's a couple of reasons for the explosion of derivatives. The single most important reason is just that if you look at the stock market, stocks are expensive. I mean, the average customer account size for traders is, somewhere between, let's say, 30 and 50,000. And, a stock like Meta is $700, Coinbase is $400, Amazon's $300, Nvidia's $200. But just, the SPYs are, almost $700. The S&Ps are 6,700.
Hmm.
You're talking about a massive amount of money to trade the underlyings, and most people don't have it. I mean, who wants to trade? If you have a $50,000 account, you can't even do 100 shares of Meta.
Hmm.
I mean, it's kind of crazy. So, um, so the reason that options have exploded, the reason that futures and futures options have exploded is for capital efficiency. I mean,
Hmm.
the strategic side to it is cool. That's really cool because the strategy is something that people love, but the capital efficiency piece is the real reason, is the real driver behind it.
Right. But at a certain point, though, I mean, I could understand where before round lots were important, right? Buying 100 shares,
Yeah,
you got a discount on your commissions. But now
yeah,
we're in like commission free, and
yeah,
you could buy one share, you could buy fractional shares.
yeah.
So does that part matter as much anymore?
No, I mean, first of all, nobody trades fractional shares. That was just
Yeah.
that was a one hit wonder for about a week.
Right.
Nobody trades fractional shares,
Yeah.
and you're right. Stock commissions are free on virtually every platform.
Hmm.
And just so you know, like every brokerage firm, when you trade a stock, the brokerage firms lose money.
Hmm.
Every single brokerage firm loses money on every single stock trade. So so we don't even care if customers trade stocks because every firm loses money. I mean, there's no money to be made on, unless you're borrowing money to buy the stocks on margin, there's
Right.
really no money in the stock business.
Hmm.
So so firms, I mean, obviously they don't care as much as they used to. There's no commissions, um, and and they tie. And what's worse than no commissions is it's kind of dead money. So you go
Hmm.
out, you buy, you spend all your money on stocks. It just sits there. Okay, great. Until you're long some stock or short some stock, but there's nothing you can do with the money then. So the reason we like derivatives and the reason we like capital efficient products is because you can do lots of different things. And lots of different things means you can take advantage of strategy, you can take advantage of law of large numbers. You
Hmm.
can you can get a you can generate returns that look more like what you expect them to look like.
Hmm. Right. Well, and just to set folks' expectations, and we're going to get into a little bit more of your strategy, but um, when you're talking about all the work that goes into the trading style that you do, because you do a lot of trades.
Yeah, yeah.
Your mantra, at least from what I remember on Tasty Trade, was trade small, trade often.
Sure.
And
That's the
um,
whole law of large numbers approach,
yes,
by the way.
exactly.
Yeah.
You
And
you can
that's
do
also
larger numbers when you're not taking big bets, right?
that's right. And also, well, that's also the way you mitigate risk. So
Hmm.
you mitigate risk by staying small. It's the only true way to mitigate risk. And then you diversify through lots of trades and you create lots of occurrences
Right.
because that gives you the best chance of success.
Yeah, yeah. I mean, you flip a coin a number of times. The only way to get 50-50 is to do it a lot. If you do it 10
Right.
times, the chances of you getting 50-50 on 10
That's right.
head flips are, very, very different, or coin flips
That,
are very
that's
different. So,
exactly correct.
yeah. So you're putting that law of large numbers in your favor. But again, it takes a lot of work because you're doing all those trades. So what is your expectation? I mean, you certainly want to get better than what you could do in like the S&P 500, because otherwise why do all that work? Do you have an expectation of,
Sure.
oh, I'm going to do this much better than the indexes if I follow a sound strategy and all of that? Or do you just kind of, how do you know you're being successful, I guess,
Okay. So I
is what it
think
comes down to.
there's a very, I have an answer for this. I can't promise anybody they can get there or whatever it is, but
Right.
the risk-free rates are X, whatever you want to say. In some cases, let's call, for simplicity's sake, let's say 5% risk-free, but they're really closer to 4% right now. So let's use 4%. Doesn't matter. Risk-free rates are 4%. So if you do absolutely nothing and you buy CDs at your bank or
Hmm.
or treasuries, whatever it is, it's about a 4% return. So that's
Hmm.
your baseline, right? That's your risk-free rate.
Yeah.
Tho- on top of that, if you're going to be an investor and you're going to invest in the stock market, you obviously have to do better than that. That's the concept of positive drift. If you're going to take risk, you're entitled to better than risk-free rates. Whether that means 6%, 7%, 9%, 12, whatever it is, that's the reason you invest in a risky investment, so you have some multiple of risk-free rates.
Hmm.
When you are a strategic player, using derivative products, using strategies and stuff like that, you have to set your objective at some multiple of risk-free rates. For
Hmm.
me, it's a minimum of 3x and it could be as high as 5x.
Hmm.
So and in some cases even higher than that. It just depends on the person. So the way I explain what we do is I'm trying to not necessarily give you asymmetric opportunity, but give you opportunity that is some multiple of risk-free rates. You have to get paid for the time you're spending and the risk that you're taking. So you're
Hmm.
not going to go kill yourself and bust your ass to make, if risk-free rates are 4%, to make 6%.
Right.
But you would if you thought you could make 22%.
Hmm.
And I'm not saying you can make 22%, but at least you have the chance to.
Hmm.
And
Yeah.
that's the difference.
Well, now, risk-free rates have certainly gone up quite a bit, starting in 2022. I
Sure.
mean, they were so low for so long.
Yeah.
So, I mean, if you were looking at 3 to 5x, it's like, oh, when the risk-free rate was 1% or lower, was
Yeah,
it
but
kind of
you
like,
can look at that as a little bit of an anomaly. When you go back
yeah.
and look over history,
Hmm.
the negative rates, the 1-2% rates, I mean, I don't think any of us thought those were here for, to
Right.
stay.
Yeah, and that certainly seemed to be the case. I want to kind of come back because again, on your roadmap of your careers, you had Thinkorswim, you sold
Yeah.
that to TD Ameritrade, and then you're like, hey, that was fun. Let's create another platform and let's put all these educational videos. You also it became a brokerage. I mean, I remember, we have our at Investors Business Daily, we have our online brokerage report that we do every year,
Yep.
and lo and behold, you had the same guys up there every time. It was TD Ameritrade,
Yeah.
Schwab, Fidelity, and so on, and then here comes Tastytrade, out of nowhere, the dark horse. How
Yeah. You guys rated us number one in the
Yeah,
country. Yeah.
because it
Yeah.
was again,
Yeah.
this was a survey that we were doing with
Yeah.
our customers.
Yeah.
So it wasn't us, giving you the stamp of approval. It was our
Yeah.
customers saying that they really appreciated what you did. So what was it that you were doing differently
Okay.
that
So
really
I'll give you
resonated
the
with your customers?
genesis. I'll give you the whole
Hmm.
genesis here, Justin, because it's kind of a fun story. So after we sold um, Thinkorswim. We were a public company, by the way, when we sold
Yeah.
Thinkorswim. And it was the middle of the meltdown and all this kind of stuff. And
Hmm.
after we sold Thinkorswim, Scott and I agreed to stay on for a couple of years for the transition, to TD. And I liked TD. I really liked the CEO. I liked the management team. No issue. But after after 2 years of a lot of conference calls and executive meetings and a big company, remember, I spent my first 20 years on the floor working for myself, and then I built Thinkorswim. So I'd spent 30 years by myself,
Right.
feeding, eating what I kill, so to speak. I had never worked for anybody before.
Hmm.
So when TD bought us, all of a sudden I was an employee for the first time in my life, and they were very generous and all this kind of stuff. But I went to the CEO after 2 years, and I'm like, you know, I love you guys, but he's like, before I could get a word out, he's like, I was waiting for this conversation for the last 18 months. And I'm like,
Uh,
and the first thing I said to him was, am I ever going to be CEO of TD Ameritrade? And he looked at me and he goes, not over my dead body. So
right.
I go, okay, that makes it easier. So
Uh,
I would like to go on because I am not a fan of traditional financial media. I would CNBC and Bloomberg would just drive me crazy. And the reason they would drive me crazy um, is because I don't care what guests think about the market. I don't want to listen to what somebody's opinion is of the market. I want it. I want ideas. I want strategy. I want quantitative stuff that actually means something.
mhm.
I understand how option modeling works, and when the expected move of an underlying is $10, and somebody comes on and says, "I think this stock could be up $100," I want to just throw something through the TV because I'm like, that is not that is that is has a 1/10 of 1% chance of happening. You cannot say that stuff. It doesn't mean anything. And so we decided that we were going to do something different in the world of financial media. And that was the genesis behind Tasty. And I remember the CEO of, of TD Ameritrade, he looked at me and he goes, what are you going to call this company? And I go, I'm going to call it Tasty Trade. And he goes, and he hated the name Thinkorswim. We did the deal. And so he goes, I hated Thinkorswim, but you were right. And I hate the name Tasty Trade, but I'm just going to roll with it. I want to be your partner.
Mhm.
And so even though I was leaving, TD Ameritrade was our first partner, and he said,
Yeah.
"I'm in. Whatever you're building, I'm in."
Mhm.
And so that was our first partner. and we went off to build a quantitative digital network. And this is, now remember, Justin, this is before there was streaming.
Yeah.
There
No,
was no
absolutely.
streaming. This is
Hmm.
2010,
Hmm.
and we were going to do a crazy show. We rented a hip hop studio. We built all this stuff out, and we're going to build this show before there was streaming. And we had never been on air or any of that kind of stuff. And we just had, within a year, I think we were the largest digital financial network in the world.
Yeah.
And it just took off. And it was kind of like a fun experience, just us making fun of each other, us talking about stupid stuff, us bringing, a bunch of quants into the world, talking about just option modeling and all this heavy stuff. And people just loved it.
Yeah, and I mean that's again where I got introduced was because I, being a TD Ameritrade client myself,
Yeah.
on Thinkorswim there was a little window that
Yeah.
I could watch, the Tasty Trade,
Yeah.
stuff. So
Yeah. We
that's
were
how I got the
partners. That's
exposure.
why I was on there. We were
Hmm.
partners.
Right. Yeah. So now, how was it kind of shifting into that level of being being a broker,
Well, here,
and
so
everything that came along with that?
it's interesting. So 5 years. So for 5 years, we did the network, building up,
Hmm.
an audience, building up everything. And we had a marketing deal with TD. So, we would introduce customers, potential customers to them. And it was very successful for both parties. It was a win-win. We got a lot of customers, they got a lot of customers from us. And about 5 years into it, they came to us and said, you know what? I know this is going to sound crazy, Tom, but we'd like to buy Tasty Trade. And I'm like, hold on. I'm like, you bought Thinkorswim, now you want to buy Tasty.
Uh-huh.
I go, how much do you want to buy Tasty for? And they go, well, we think, now we had no idea what we were worth at the time. We knew
Yeah.
we were good at what we did, but we didn't know what we were worth. And they go, we'd like to pay you a couple $100 million.
Huh.
And I'm like, I really appreciate that. That's a validation of what we're doing. But myself and my partner Scott and Christy and Woody, we were all partners. And Christy and I kind of looked at each other. We go, if they're willing to pay, let's say, $200 million for us, then we must be worth 400.
Right. Yeah.
That's what we thought. We're like, because they're not paying over the offer.
Yeah. Yeah.
So we politely declined. We were like, listen, we like you guys, you're our friends, but we're going to decline, and we're going to go ahead and just do our own thing.
Hmm.
And they're like, ugh, they weren't mad, but they were just like, we understand, we respect you, but they kind of knew that meant we were going to build another brokerage.
Right. Yeah.
And we built another brokerage, and we were right. It was, Tasty was a great marketing engine, and we were really clear of the concept from building Thinkorswim. We knew what we wanted this time. So we built a faster, leaner, more efficient platform with a better marketing engine. And 4 years later, we sold Tasty for 1.1 billion.
Hmm. Yeah. So, uh, talk a little bit about, again, you said you learned some things from Thinkorswim, and so when you kind of approached Tasty, you said, okay, here are some things that we wanted to do differently. I mean, there's certainly, I'm sure, the back end of things that you learned, to make it
Yeah,
more
sure.
efficient and everything. But were there any like really big things that you're like, this is what we learned from our customers and what they need, and this is what we can provide, and so what did you do there?
Well, there's two questions in there. The first part is we learned that when we built Thinkorswim originally, one of the things we differentiate ourselves on is we lowered our rates, lower than anybody else for options, and we did a bunch of things that nobody else did. So there was a rate angle in it at first. There was also a technology angle, like our
Hmm.
technology, the Thinkorswim technology. Remember, in 2001, blew away every other platform. There was nothing else like it. So it was so much better than technology everywhere else. So we had a technology advantage, and we had a pricing advantage.
Hmm.
When we built Tasty, the technology was better. I think our technology is better than anybody else, but the difference is much smaller. Like, everybody's fast, everybody's stable now.
Right.
So the difference in technology from one platform to the next is usability. It's not really
Hmm.
like speed and stability and that kind of thing. So the technology's been commoditized. The rates are the same everywhere. It's like
Hmm.
everybody's free stock, everybody's has low rates. There's no advantage to rates anymore. Nobody moves the
Commoditized.
rates. The rates have been completely commoditized.
Hmm.
So what we did differently when we built Tasty was we decided we'd go the content route. And our differentiator was our content. And nobody else, I mean, since we built Tasty, now TD Ameritrade has a network, Interactive Brokers does something, Ninja Trader does something. Everybody has their own but nobody had that at first. Our
Right.
differentiator was our content. And our content was also, us. Like you couldn't replicate our content
Hmm.
because it was our shtick. It was our story.
Hmm.
Now, when you ask what we took from the customers, I'm going to give you a very Steve Jobs like answer. We love our customers. We literally hang with our customers. We go do live shows. We spend tons of time with them. We answer every single email personally, but we do not listen. And it's a very important
Yeah.
thing about being an entrepreneur is if you listen to your customers, you will die
Yeah.
because all the customers know is what everybody else knows. They're all watching the same movie. They all want the same crap. We would have never built Thinkorswim if we listened to customers. We would have never built Tasty because we built everything that we wanted. We built, remember, I make 15,000 trades a year.
Hmm.
Scott makes 12,000 trades a year. We all are junkies.
Hmm.
We know what we want to see. We know what products we want. We know what strategies we want. We know how we want the platform integrated. We make our, we make our CTO. We make all of our devs trade because we want everybody to know how this technology works. If you go anywhere else, I promise you, there's not another CEO in the entire online trading world that trades. Not one. I will bet my freaking life on it. And if you said, you know, do the CTO trade? Nobody uses their own platform.
Right. Yeah.
I've sold two platforms for $2 billion, and neither place that bought them, the CEO had ever even seen our technology.
Right. Yeah.
So it doesn't. So I'm. It's the craziest thing, but you have to just go with what you believe is going to be the differentiator. And
Hmm.
so yeah, I'm not a I'm not a focus group guy, as you can
Yeah.
imagine.
Well, and again, because what you were doing was really kind of giving the customer something that they didn't know that they wanted or needed. It
Of course,
was, you know. Mhm.
that is what really good entrepreneurs and visionaries and creative people do. They have this idea and you roll with it. If you do what everybody else wants, then you're no different than anybody else.
Yeah. So again, you're bringing a lot of experience to the platforms that you're creating. Let's talk a little bit about your strategy. We already alluded to, again, for anyone that's followed you, the trade small, trade often. Um, let's talk about your risk management because again, everything really seems to come down to risk management. And all of the best traders that I've ever studied, it's risk management.
Yep.
Number one, being able to survive, the longevity thing, being able to survive and do it for a long time. And it always feels like if you're able to keep your losses small, then you don't get hurt. And when you do have those wins, they can matter for you. So, what is your approach to risk management?
My approach is very different than everybody else, and I I feel like this is the only approach that works. I
Hmm.
mean, over time, you have to be very careful about adding to losers. People get very stubborn, and the and I've watched a lot of people lose all their money from the trading floor all the way through retail, and I've watched a lot of people survive for a really long time. And the way I like to say this is when genius fails, when you blow up, it's always because of the size. It's always because you trade too big. Either you threw good money after bad, you made a bad
Right.
trade, and then you double down, or you just get too big. And
Hmm.
that's how everybody fails.
Hmm.
The key to risk management is not stop orders. The key to risk management is not taking losses. That is the biggest misconception. It has nothing to do with taking losses because losses are random. Some come back and become winners, some make losses even worse, but that's a completely random decision and it's totally subjective. The key to risk management is staying small.
Hmm.
That is the only way you can defend yourself. If you stay small, you can defend yourself under any circumstance. And that is the key, the ultimate key to risk management. Stay small, don't add to your losing positions.
Hmm.
And then
Well,
you'll be around forever.
Well, at a certain point, though, you have to have a strategy. It's it seems to me at least, it's not enough to stay small, because you have to have a strategy that at least moves the needle for you, something that puts some type of gives you some type of edge, some type of odds in your favor. Otherwise, if you stay small and you're never, it's still a 50-50 thing. Well, what does it matter?
Well, it's
So how do you?
50-50 if you're trading just stocks, but you can, when I say you stay small,
Mhm,
that doesn't mean you can't be 50, 60, 70, or 80% invested. That
mhm,
just means each investment is relatively small and hopefully has somewhat non-correlated. So you don't go down, you know, if something ugly happens on either side, you're
right.
not, all your eggs aren't in one basket. That's all it
Yeah.
means. It doesn't
And
mean to use 5 or 10% of your money. What it
mhm,
means is that you allocate capital appropriate to opportunity.
mhm,
And there's a relationship there. Whether we use volatility, but you can use anything you want. You can use price, you can do whatever. We happen to use volatility, but and higher volatility meaning more opportunity, lower volatility meaning less opportunity. But either way, each individual trade should be less than a certain percent of your capital. Like you
mhm,
should not be 80% in one underlying.
right. And so what is kind of your rule of thumb there? And I'm sure it depends on the trade, but as you said, most people think of, okay, your portfolio risk, or
Yeah.
what is my position size going to be here? So what's a normal position size for
It
you?
depends a little bit on account size because that does come into play. But
Hmm.
for an average size account, and again, that could be anywhere from, 30, 40, 50, 60, 70,000, which is the average size, retail account. Um, you want to be careful that you don't exceed 10%. I mean, there's certain cases where you can make the argument to get to 15% of your net lick, not of your
Hmm.
buying power, but of your net lick. Um,
Net
and
liquidity, right?
yeah, you
Hmm.
just your actual
Just
the actual
translating your terms.
yeah, yeah, net liquidity is just the
Yeah,
amount of money at theoretical value that's in your account.
right.
And so if you have $50,000, you want to limit kind of max to a single trade at maybe 7,500. It should be more around 5,000 max if you're buying stock. If you're trading options, it's obviously going to be less than that. But the
Hmm.
key to all this is just, I don't care how much of your capital you use. I just care that you not all committed to one single underlying.
Hmm.
That's all.
So this is another thing that's kind of important about what you do is, while you do a lot of trades, you kind of limit yourself to you're not trading every underlying. There's you kind of know your underlyings, and you're just kind of structuring
Yeah,
different trades for kind of the same underlying sometimes, right?
100% because we're pretty indifferent underlying. So in other words, I'm about 70%. I trade about 70% listed options and about 15% futures and 15% listed futures options. That's pretty much the breakdown. I have
Hmm.
some crypto and some stock, but I'm kind of mostly all derivatives. Um, but I don't care what the underlying is. So the strategy that I'm going to use if I'm trading the Japanese yen, the euro, um, soybeans, or natural gas is the same strategy I'm going to use if I'm trading Amazon, Coinbase, Palantir, or Roku. It
Hmm.
doesn't the models that we build and everybody else builds for the underlying derivatives. It doesn't matter what the product is; they're all the same models.
Hmm. Yeah, that makes sense. So, how do you choose, I guess, how do you choose what to go after?
Well, it depends what kind of trader you are. So I'm a
Hmm.
contrarian. So for me, it's easy. I just do the opposite of what everybody else is doing, and sometimes that works really well. On days like today, it doesn't work very well at all,
Uh-huh.
um, because we just have every day has been Groundhog Day recently.
Yeah.
But I'm not a trend trader. I'm the opposite,
Hmm.
and that goes back to my floor trading days when we just took the other side of, like I'm the kind of person who if you want to make a bet, I'll take the other side, no matter what you
Hmm.
want to do. I'm just assuming that you're going to be wrong. It doesn't mean you are. It's just that's just how my mind works.
Yeah. No, 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 absolutely. So, let's also kind of talk a little bit about, um, you know, your models,
Sure.
because you have done so many models, and again, this was one of the great things about your content was that you would share like, hey, this is what our models say, this is what our statistics say. So how did you kind of attack those studies? You've done so many studies on the market. How would you attack those? I mean, would you
It,
say we need a sample size of this much, or what, how would you do that?
well, we've been building our own database for research. I mean, Tasty. We built a think tank. Is essentially what it is. We built uh, a think tank, a network that was kind of attached to a broker. And on the think tank, um, we hired a lot of people that are a lot smarter than we are, than
Right.
the on-air talent is.
Mhm.
We hired data scientists, physicists, mathematicians. Um, I I am not I am not too proud to say, I'm not too egotistical to say that we have a team where everybody in that team has the depth of what they understand. It's just off the charts, and they're crazy smart. And what we've done is we've challenged them with, listen, I'm not putting any limits on you. You want to get
Mhm.
deep into the weeds on some, advanced calculus thing to show how modeling's done. If you want to do something, all I won't let you do is tell us what you think, because I'm not interested in what you think is going to happen. I'm
Mhm.
only interested in you presenting the numbers based on all the research that we've done and based on all the data that we have. So, what I want to do for individuals is optimize their decision making.
Mhm.
I want to do two things. I want to speed up their decision making, and I want to optimize it. And that's what no media network has ever done before. I don't care what somebody thinks about some underlying. I only care you give me the optimal amount of days in a decay curve that I should be putting a position on. You give me the optimal delta and strikes that I should do. You give me the optimal strategies for something, and then you give me the data to support all that. And that's what I want to see.
Mhm.
I will, I will add the numbers together. I'll do the 1 + 1 = 2, or 1 + 1 = 3 or 4, or whatever it is. And I want you to give me mechanics that let me optimize my trading so I have the best chance of success. And that's it.
Mhm.
That's all we can do.
Right. Um, one of the elements that I just want to get back to, because I want to put a pin in the models for a moment, but I want to
Sure.
get back to something before we get back to the models is the correlation part. And one of the things that is probably very difficult in this market is with AI being such a huge subject,
Sure.
and there's so many things that are kind of like, oh, this is going to happen because of AI. It's affecting utilities, it's affecting nuclear energy, it's affecting HVAC systems, all of this kind of AI adjacent stuff. And we saw that with DeepSeek on January 27th of
Yep.
this year, where all of these, what you would have normally thought of as uncorrelated groups, came down together. Um, and you've really stressed how important it is to make sure you're not getting overly correlated. How do you do that in a market like this where it feels like the correlations are going more and more towards one?
Yeah, I mean, part of it is just an understanding of how correlations work. In bull markets like we're in now, correlations are very scattered. Like, even in the tech world, one tech stock like today, for example, Reddit's down, and some stock that's highly correlated to it, like Palantir or something, might be up.
Hmm.
So the correlations in an up market are a little bit strange. In a down market, they all go to one.
Yeah.
In a down market, everything collapses to one. So so correlation is easier to talk about than it actually is to implement. And the way good traders do that, especially in the retail world today, is you are not scared of trading all products. Like, I mean, there is no correlation between bonds and stocks anymore. There's no correlation, between gold and Bitcoin, for example. There's no correlation between crude oil and natural gas anymore. So and there's no correlation, just to go down that line, there's no correlation between 10-year notes and tech stocks.
Hmm.
And so there are plenty of non-correlated plays out there, but to put it all together, it's not something that's very easy. And there's no platform that currently shows you your overall, the correlation of all your underlyings. I mean, we teach it, but it's hard to program in.
Implement.
And
Yeah.
we do beta weighting, and we do some really cool stuff on a portfolio level, but the correlation on a portfolio level it's a little bit of a challenge.
Yeah. Well, speaking of challenges, I want to kind of get into your next venture. And,
Sure.
so again, for those that saw Tasty Trade, your goodbye there, it doesn't mean that you're stepping away from everything because you just seem like, you can't sit and relax. And by the way, does this have anything to do with the fact that you aren't wearing your signature beret?
Yes, it does
Right.
have a little bit to do with it. For
Yeah.
25 years, I've worn that beret,
Uh-huh.
at black one at Thinkorswim and a gray one at Tasty Trade.
Uh-huh.
And everybody's like, "Do you have hair?
Right.
Like, are you
Right.
bald? What's the deal?" And I'm like, "No, I just my hair is long. It's just kind of like I don't know. It just became a signature thing."
Yeah.
Um, I'm going to be completely honest with you about. I mean, I'm honest about everything, but when I didn't even take a day off.
Oh
And
my
I don't
goodness. Yeah.
need, it's not a money thing. It's not like,
Hmm.
I'm not, I mean, obviously I've had a great career, but I feel like I need to challenge myself. Like I need to keep moving or I'm going to
Hmm.
die. I need to
Yeah.
challenge myself or I'm going to die.
Isn't that
And
like the fish that,
yeah,
has to
yeah,
keep on moving,
same thing,
right? Yeah.
same thing.
Yeah.
And my wife's like, "You're not even taking a day off." And I go, "No." I mean, I went
Uh-huh.
from my goodbye video to right to my next gig.
Hmm.
Um, and I was very clear in the video. I'm not retiring, but I need to be challenged,
Hmm.
and I like to make decisions. I don't. I'm for the last 4 years after we sold the company, I'm not really. I love what I do. That's why I stayed for 4 years because I love Tasty. I still love Tasty. It's an amazing company, and they're going to do great. But it was time for me to build something else because I love
Hmm.
building. And so now I'm in a room with, about, I'd say 12 or 15 people we have, all techies. And we're about to launch another streaming network called One Lucky Dog. And we built a platform called Lost Dog, LOSSDOG.
Hmm.
And we've been building it for quite a long time because I just took over as CEO, this last week. And um, I am focusing on something that I think is a big problem in the world, on wealth inequality and economic fairness.
Hmm.
I think that it's ridiculous that there is a CEO that can make, 50 million, 500 million, $1 trillion, what they just package they put out to Musk, and the lowest worker on the totem pole makes, 50,000.
Hmm.
There's a wealth gap in this country that is, um, it's very disingenuous. It's it's a big problem and it's going to become a worse problem. And
Hmm.
so I'm like, Scott and I are going to build a company this time where we're not going to take any money. So we're gonna practice what we preach, no money, and we're gonna build a company that helps people to narrow the wealth gap. We're gonna help people differentiate themselves. We're gonna help people using option modeling. This is not like I'm not a psychologist. I'm not a psychiatrist. I'm not going to sit there and say the
So
right
you're not
path
doing
is.
life coaching.
I'm not doing life coaching. I'm
Right.
actually giving you numbers. We built our
Uh-huh.
own we built our own version of a Black-Scholes model that will help people to know exactly what they're worth and what they're leaving on the table over a lifetime, and so that they can close that wealth gap by understanding with real context, with quantitative statistics, what they're actually worth and how to
Hmm.
get that additional money that they're worth from their employer or to go somewhere else. And on top of that, we're building a digital ecosystem that will allow people, like this very cool stablecoin concept, and it goes way beyond that, that will allow people to learn how to make investments, that will
Hmm.
teach people how to, I'm not teaching people how to manage, how to balance their checkbook type thing. This is how to think differently,
Yeah.
how to think risk wise, how to think making a lot of decisions with respect to risk. I'm all for people learning how to take risk in aggressive ways, but at the same time giving you context around what you're really worth and how to make yourself worth more over the course of your lifetime. I mean, the average person leaves over $2 million on the table over 30 to 40 years because they
Wow.
just don't know what they're worth. And
Hmm.
that's a very low number. That's
Hmm.
like the minimum number we could come up with was around a little over $2 million, 2.1 million. Sometimes it's as high as 6 to 10 million over a lifetime. And it's just from not knowing. And we're going to change that. And we're going to do it in a very fair way. So it's going to be incredibly generous to the consumer. And we're going to do a show around it.
Hmm.
And we're going to have a lot of fun. And we're going to talk about ways to differentiate yourself. And we're going to talk about, different things. We're going to be political. We're going to be funny. We're going to be a little outrageous. We're going to be definitely unfiltered. And it's going to be a really nice way for me to wrap up my career.
Yeah. Well, and it's so interesting because again, there have been so many elements, that you have really kind of upped the education part. Again,
Well, think
there's
about think about this.
yeah.
What
Uh-huh.
is the way? How do you change? How do you change this wealth disparity, this wealth gap in the world? You know what it's? You know how you do it? It's through education.
Yeah.
It has
Hmm.
to be through education. Like basically teaching people, just like we taught trading, and we did it through technology and lots of other things, but
Hmm.
we engage people. It's the same thing here. You have to engage people to reduce the wealth gap. You have to engage people. And I think we have a model that will do that. And it's all through learning and education. It's all through know-how.
Hmm. Yeah. And that's again, it makes such a big difference. Now, there is that other element of resources, right? Isn't there like kind of a combination of, okay, if you have all this knowledge but you don't have the resources, how do you kind of help bridge that gap?
You know, that's another challenge. But
Hmm.
from I can only I can bite off so much.
Right.
And like don't make me solve all the world problems, okay? Let me deal with something that's a pretty big one and
This
then
is big enough, right?
yeah, this is big enough. Like I just want it. We lived in a world for the last 25 years that was very it was very niche, like
Hmm.
there was I lived in a world of derivatives and trying to get the average self-directed investor to engage just like you to engage in derivatives and do things that you weren't necessarily comfortable with before we built the technology or the content. That's a challenge, and we
Yeah.
love that challenge. But
Hmm.
now I want to go broader and introduce like differentiation to even more people. And I feel like it's a massive challenge,
Hmm.
and I feel like it's going to keep me going for a long time, and it's going to be fun.
Yeah, well, and in some ways, when I first was watching the Tasty Trade stuff, it was almost like learning a different language
Yeah.
because there were things that you guys just throw around so nonchalantly, and I'm like, and the numbers and everything like that, and I'm like, wait a minute, what is a jade lizard? And I'm having to pause the video, look it up, and this vertical spread, bull put spread, and all that, and sometimes it's different names. You'll call it a credit spread or you'll call it a bull put spread, and it's the same thing.
Yeah.
So there is kind of a language part to this education, and I think maybe that's one of the
You
things that
know
a lot
what's
of folks are
funny is
missing,
when
the
we built
financial language. Yeah.
when we built all these platforms, we said from day one, A, we're not going to dumb them down,
Hmm.
and B, we're going to talk like we talk. Like we have our
Yeah.
own little language, and we're not going to change that language. For we're gonna make people we're gonna engage people from using like a different set of different terms that haven't heard in the past.
Hmm.
And we made up all these every name, virtually every name that you hear in the world of finance today that has to do with derivatives, we made it up. Like, you just mentioned the Jade Lizard. That's Liz and Jenny made that one up. But
Uh-huh.
we've made up every single name. We have all these crazy things, and people like it's just common throughout the whole industry. But they've become mainstream. But we just sat around and made them up over the years, and they've caught on, and everybody's picked up on them, and it's been a real validation of what we built.
Yeah. Well, I can't wait to see what you do here, Tom. I'm a big fan of what you've done in the past, and I mean, this just
Love it.
sounds incredible. So, just as a reminder for folks, lostdog.com, that's LOSSDOG.com, and then the content is going to be on a show, One Lucky Dog, right?
That's right. Launching
Okay.
in November. And
Launching in November.
right now there's just a sign up so you get on the wait list.
Okay.
But one
At
lucky dog.
lostdog.com, right?
Yep, at
To get on that
lostdog.com.
wait list.
Yep.
Perfect. Well, Tom, we'll have to have you back on to kind of talk a little bit more about your stuff and see how things go. But good luck to you, and I can't wait to see what you do.
Love it. Thank you.
Okay. That's going to wrap it up for us this week. And thank you so much for watching. Again, it's always great sometimes to get on that bigger level of strategy and everything else. And that's what I feel like Tom does for us. Next week, we're going to get a little bit more into some of the details on a specific strategy with Viva Josh. She's been on a couple times before on IBD Live and on the podcast where she's using leverage products and how she does that, the rules she uses. So please join us for that. We're going to get her thoughts on the current market, and we hope you join us. Take care, everybody. Have a great one. Bye bye now.